Imagine you have just taken a trade ahead of non-farm payrolls with the expectation that if the reported number is higher than the forecasts, you will see the price of Euro USD increase quickly, enabling you to make a hefty short-term profit. NFP comes, and just as you had hoped, the number beats forecasts. But for some reason, price goes down. You think back to all the analysis you had done, all the reasons that Euro USD should be going up, and the more you think, the further price falls. Today, we're going to talk about the importance of emotional control in trading, and I'll also show you a very interesting and profitable strategy that I often use myself. Let's start by delving into the strategy, and then we'll discuss emotions. I really hope I'm helping you navigate the world of trading through my YouTube videos, so make sure to subscribe so you don't miss out on any new content. Do not forget about my Telegram channel. We're growing steadily and becoming more confident. Join our community of real traders. I'll help you to make a profit. And now, sit back and enjoy. Now, let's take a look at how the strategy with 2 moving averages works on a real chart. We will try to find a situation suitable for trading for this trading strategy. Let's show you how it works so that you can decide whether to use this strategy for your own trading or choose something else. This trading strategy involves 2 moving averages, works really well on the stock exchange, but it's also suitable for binary options. First, let me show you how to add the indicators. Click on the Add Indicators button and then type MA in the search bar, then click on Moving Average Simple. Add 2 of these indicators since we'll be using 2 moving averages simultaneously. Now the indicators are added and you need to click anywhere on the chart to close the search window. Next, we need to set up our moving averages. Click on the gear icon and set the period to 20. For the second moving average, set the period to 5. So click on the gear icon for the second moving average and enter the number 5 in the same way, leaving everything else unchanged just as it is. The only thing you should do is change the color of the moving averages in the Style tab to make it easier to distinguish them and understand the signals. The SMA with a period of 5 will be our signal line, so we'll make it wide and slightly thicker to see when it crosses the main 20-period moving average more clearly. That's it. We've configured the indicators. Let's see what situations we have for our strategy. In general, we can see that just a couple of minutes ago, there were many breakouts that could be in profit now. Now let's take another look at the USD and Canadian dollar currency pair. Here's a quite interesting situation. See, the price crosses the 20-period moving average and our signal 5-minute moving average also starts to cross it. In simple terms, when the price and the 5-period moving average cross another moving average, we can go for a buy. So we have now entered a buy trade. We're currently experiencing a breakout of the slower moving average to the upside, and consequently, we get a signal to buy. Furthermore, there is currently an uptrend on this currency pair. Everything here indicates that the price should rise, but in general, if we delve a little deeper into how the strategy works, it can be said that moving averages have been used in stock trading for over 2 centuries, and the development of such strategies began as early as 1901, when mathematicians identified certain patterns and new price behavior algorithms. Back then, analysts started drawing the average prices values on the chart and came up with the name moving average. Moving averages are as old as RSI and stochastic, very, very old and reliable indicators. Despite their age, these analysis tools still work and show quite good accuracy if used correctly according to the market conditions. Let's get back on the moving averages. Over the years, and with the advancement of technology, programmers have developed a programmed version of the moving average indicator. Then they came up with various types of moving averages, such as the exponential moving average, weighted moving average, and others. We are using the simple moving average specifically, and the essence of the strategy is that there are two moving averages and their signals coincide simultaneously. For analyzing currency charts with this strategy, we use a 1-minute time frame. On this time frame, it delivers the best results and frequently generates signals. On higher time frames like 5 minutes or 15 minutes, signals will appear much less often. A 1-minute time frame means that each candle on the chart represents 1 minute. As I mentioned, you can use this strategy on different time frames, but I recommend sticking to the smaller ones, not exceeding 3 minutes, because trading opportunities will be scarcer on longer time frames, and you'll have to wait quite a while for signals. Once you've decided on the time frame, you need to add two moving averages. In other words, do what I explained at the beginning of the video, add one moving average with a 20 period, the so-called slow moving average, and another one with a 5 period, the so-called signal moving average. With everything on your chart, you can start looking for signals. Pay attention to when the signal moving average crosses the slow one. If the 5-period SMA crosses the 20-period SMA from below to above, we open a buy trade. In case the signal moving average crosses the slow moving average from above to below, we open a sell trade. The expiration period is typically the standard 3 candles, which means 3 minutes on our 1-minute time frame. By the way, there are a few seconds left until the trade closes, and we're obviously closing in profit. Well, there you have it. The trade closes in profit. Although there was a slight correction and consolidation here, the price ultimately moved up in accordance with our signal, and as a result, the trade closed in profit. As you can see, the strategy works well, and it's straightforward to use. The 3 most common emotions traders experience. Some of the most common emotions traders experience include fear, nervousness, conviction, excitement, greed, and overconfidence. Fear and nervousness. A common cause of fear is trading too big. Trading with improper size magnifies volatility unnecessarily and causes you to make mistakes you normally wouldn't make if you weren't under the stress of risking larger losses than normal. Another culprit for fear or nervousness is you're in the wrong trade, meaning one that doesn't fit your trading plan. Conviction, excitement. Conviction and excitement are key emotions you'll want to feed off, and you should feel this in every trade you enter. Conviction is the final piece of any good trade, and if you don't have a level of excitement or conviction, then there is a good chance you are not in the right trade for you. By right, we mean the correct trade according to your trading plan. Good traders can be losers, just as bad traders can be winners. The idea is to keep yourself winning and losing on only good trades. Making sure you have conviction on a trade will help ensure this. Greed and overconfidence. If you find yourself only wanting to take trades that you deem as possible big winners, you could be getting greedy. Your greed might have been the result of doing well, but if you aren't careful, you may slip and end up in a drawdown. Always check that you are using proper trade mechanics like sticking to stops, targets, good risk management, good trade setups. Sloppy trading as a result of overconfidence can end in a strong run. I appreciate your time and attention. I want to express my gratitude for your viewership. If you enjoyed this video, kindly show your support by hitting the like button and dropping a comment. Your participation is eagerly anticipated. Feel free to become a part of our community on the Telegram channel. I will be there, eagerly awaiting for your presence.